providing financial straight talk for those working and enjoying life after work. This is America's financial headquarters.
There's a lot of opportunity out there that exists. There's a lot of unknown, obviously, with the fiscal cliff, but there is one strategy that everybody might wish to consider, and there's not really going to be a lot of risk associated with this strategy. So we had received a call from Tom in Kalamazoo, Michigan, and we're going to use that to kind of catapult our discussion today. Tom had called in on the 24/7 hotline at 888-888-9572 and left us this voicemail.
Gentlemen, first of all, I'd like to say thanks for your show. I really appreciate the insight you guys are providing us. Got a question for you. My parents work with one of your network advisors who had discussed Roth conversions with them near the end of the tax year. They're both retired. However, I'm still working. I wanted to know if it made sense for me to consider a Roth conversion as well.
Well, Mark, I think sometimes there is an opportunity to make a blanket statement that says a Roth conversion is potentially something that everyone should consider. It's not necessarily the best decision for every single person out there, but it is a fabulous tool, and depending on your personal circumstances, a Roth could be appropriate regardless of age.
Yeah, you're right, and I think it's important to understand, he had mentioned that his folks work with one of the HQ network advisors, and they are already retired. The decision and the decision-making process that goes into somebody who's already retired, whether or not a Roth conversion makes sense for them, is a little bit different than somebody who's still working. So it will be helpful, I think, for everybody to understand the differences between the two, when somebody who's retired might wish to make this consideration versus when somebody who's working. So let's first of all look at a retiree.
Sounds good.
Now, I'm going to kind of create a fictitious person for our example here, but let's assume that you are 60 years old and you have $500,000 in your traditional IRA. So maybe it was a 401k, now it has been rolled over to an IRA. Now, hypothetically, let's also assume that you don't need access to that money for 10 years. Okay? Now, if you look at that $500,000, and let's just attach a hypothetical rate of return to that $500,000 of 7%, okay? In 10 years, that $500,000 would have doubled to $1 million. You're following that?
Yep.
It's the old rule of 72 that's out there. So at age 70, now this retiree has $1 million in their IRA. And at age 70 and a half, the IRS is going to start forcing people to take distributions.
Required minimum distributions.
From their IRA. Okay. Now, this person will have to take a factor based on $1 million. Okay. And every dollar that comes out of that traditional IRA is going to be taxable. Okay.
Exactly.
Now, if you do the math on that person who's now 70 and you stretch out their lifetime to, let's just assume they're going to be 90 years old. Okay, and you assume that money's going to keep growing, and you also assume some distributions off of it. That person will likely have taken in excess of $1 million of distributions over the course of their lifetime. Plus, they would still have, a good chunk of money, hypothetically, still remaining in the account. Okay, think about this. What would the tax bill be on the $1 million worth of distributions? And let's just assume you had $1 million still left in there when you passed to go to your beneficiaries. What's the tax bill going to be on a total of $2 million?
Huge, because it's all taxable.
It's all taxable. So I'm just talking some generic numbers here, but let's apply a 25% rate to that. That's $500,000 of a tax bill on an account that, if you remember, Mike, at age 60 was only $500,000.
Right.
So you're paying $500,000 of tax on a $500,000 account.
Right, as it stands today.
So the Roth conversion, you can pay tax on that entire $500,000, and by getting it into a Roth IRA, you've now turned a 100% fully taxable asset into a tax-free asset, both on the growth side as well as on when you take income from it down the road.
Which means from that point forward, if you make that conversion, that money is always tax-free from that day forward.
Correct.
And also one of the cool things about converting to a Roth is that's what's called qualified money. So that's all pre-tax money in the existing IRA before you roll it. Mm-hmm. And if you are going to convert to Roth, you also can pay those taxes without outside money,
Correct.
with non-qualified money that you have in other savings. So now you can keep that full conversion intact, that full $500,000 in your example, and now all of that money gets to run tax-free. You didn't even have to force the tax payments out of that particular account.
And the other thing is that you don't need to take required minimum distributions from a Roth. So let's say you get to age 70, 75, and you don't need income from it, you don't have to take it. Whereas in the traditional IRA, you're going to be forced to take it. Now, everybody, it's important to understand that we're talking some big dollars here. You do not have to convert your entire chunk of IRA money. You can do it in small chunks. You can do 50,000, 100,000. And here's the best part. Here's why everybody should consider this come year end here. With the fiscal cliff looming, tax rates are projected to go up. So you can pay the tax on that conversion today at 2012 rates, and then if they were to go up, you were a winner because you paid at a quote-unquote a lower tax rate. Now, in the event that they didn't go up or they went down, now I don't foresee that happening. In the event that that happened, you can get a do-over, and you can recharacterize your conversions.
Right.
So next year, if you wanted to say, hey, that wasn't the right move for me, you can recharacterize it as though it never happened. So it's really, it's a win-win proposition if you want to consider that. Now,
it is a complex decision as well, and so that's one of the reasons, as we're sitting here talking about the merits of should you convert or should you not convert to a Roth, it's also important to take advantage of the Financial HQ network advisors that are out there, because they can sit down and they can go through this with you specifically.
Now, you're listening to America's Financial Headquarters, and we're discussing, the pros and cons to Roth conversions and, some of the decision process that goes into that. Now, Mike, let's discuss a little bit about the worker. Somebody who's still working today, maybe they aren't retired, but should they consider a Roth conversion? Now, here's one thought, and I encourage this for a retiree or somebody who's still working. If you look at the tax brackets, I'm just going to assume married filing jointly, the tax brackets of today, $70,000 is the line in the sand for a 15% tax bracket. Okay? So let's assume that you're a worker or you're retired, and let's assume that you earn $50,000 of taxable wages. You still have $20,000, the difference between the $70,000 and the $50,000, of a 15% tax bracket that you can consume. So what goes into this decision is this. If you took $20,000, let's say you have an IRA out there that whether it's $20,000 or $50,000 or whatever, just convert $20,000 of it. You're going to be able to pay taxes on it at the 15% rate.
Okay.
Down the road, when 15, 20, 30 years from now, when you plan to consume that Roth IRA, maybe you're going to be in a tax bracket that's going to be a little bit higher, but all of the growth that has taken place on that $20,000 that we converted will have grown tax-free, and the distributions out of it will come out tax-free, income tax-free.
It's interesting because everyone, when they hear about a Roth IRA and its ability to be converted from a traditional IRA, they all understand when they see the numbers laid in front of them, they all understand it's a great idea. They all understand it makes perfect financial sense and that everyone should do it. And yet, from a percentage standpoint, the vast majority of people out there still are not converting, and it's because they don't understand they can do it in pieces, like you mentioned. Right. They think they have to do it all at once. They have to take that big bite out of the front end, and yet they let it run in a very expensive mode on the traditional IRA. So it's kind of like, I pay a bus ticket up front versus I pay a taxi cab as I go. If you just pay up front, over time, you'll be much farther ahead.